Good morning, everyone. Paul Duncan here with GammaEdge. Today is Thursday, February 17th. Let's get started. Still bearish, possibly seeing some volatility with the expected moves, but we'll have to see how it pans out for today. We start with the market. So first thing that you should be doing is taking a look at Taylor's market view in the GammaEdge Discord under market status, where he reviews all of the actions from the previous day and gives us a glimpse of what we should be looking at as we go forward. We break things into three buckets. Short term, the cumulative tick model is attempting day over day higher lows. That's a good thing. We want to see more constructive behavior there. Medium term, we still have terrible breadth, as indicated by the 52-week new high, new low model. This is not a daily indicator. This is a medium-term indicator, and generally tells us how expansion is working or contraction is working within the overall market. The cumulative tick model is attempting to break through what we call the ribbon, and this moving average ribbon tells us where we've been, and when we are penetrating that ribbon from below, it's usually a good thing. We just have to get there. On the longer term, though, the ribbon is actually inverted, which means the longer moving averages are on top, and that means overall it's still bearish, and it's going to remain bearish until we get above it, and we stay above it for a lengthened time, and we're not there yet. From the ES perspective, when we look at the March contract, we've had no change in the gamma strikes, so that's a good thing. The ES structure is intact. We're not moving around, not a lot of volatility there. We are trading right at the option zeros, and what I view that as is that there's no pressure or imbalance to move either way. So I don't want to say we're pinned. We're certainly not pinned, but we are right in the neutral area, neutral zone. So any winds can blow us in any direction, actually. The VIX and the VVIX, both are elevated overnight relative to the previous close, but in general, although they're very news sensitive, we are seeing a slight drop in the VVIX, so we'll have to watch that into the morning session here. From the SPX perspective, we are still in a net negative gamma regime, but it is improving. We're digging out of the hole that we were in from earlier in the week. The range for the SPX today is wider than expected. Just remember, everyone, today is the last day that the monthlies trade. That's the AM settled monthlies, and that could be giving us this divergence that we see in the wider numbers on the SPX side. The short term SPXW flip, which is another type of zero that we use when we say short term. This is the PM settled. It's dropped a dramatic amount. So where the primary level is up at 45.20 or in that zone, 45.19, 45.20. The short-term flip has dropped a lot, and we think this is going to keep us within that range of that 44.55 to 45.20. We'll have to see. So when we take a look at the cumulative tick, as I said, the breadth is terrible on the 52-week new high, new low indicator. The cumulative tick model is still inverted, as I said, and that's bearish, and then it's sloping down also. We need this white line, which is the instantaneous cumulative tick, to push above, and you effectively invert this model, but that'll take several days of sustained levels above this. From the ES perspective, as I said, the VIX is elevated relative to where left off, but overall the complex has not changed from yesterday, which is neutral. We are trading right at the zeros. We continue to remain in this range, and between the 43.35 level and up here at the 45.85, it really is anyone's game. We can see the winds could blow us in either direction fairly easily. There's not a lot of pressure in either direction. When we take a look at the PM settled and then the combo complex, this is where we get that divergence in the expected moves. I put a box around rough areas of where we could actually move based upon the pricing of the options and volatility. The key thing to look at here is the 45.10 is where that JPM hedge long put that are expiring at the end of March are located, and you can see that just dominates the overall areas here. So watch that 45-10 area to be very, very sticky. I don't think we're going to push aggressively through it. We'll see, but it's dominating the conversation right now. It really is taking all the air out of or oxygen out of the air in the room. On the other side here, again, remember the AM settled. Today is the last day that those are going to trade. You can see there's a transition up in here between the 4480 and the 4500, where we're going from a net positive number of shares to hedge to negative. So we want to watch that fairly substantial level here at 4500. When we take a look at the 1 DTE, key that I want you to see here at circle 1, this is only one expiry. Circle 2 shows us that we're net positive on the expiry. Circle 3 shows us it's virtually zero. 692 contracts net gex is not a very big number here. And so basically we're at the fulcrum of the teeter-totter, and that's important. What I want you to realize is that it's no surprise we ended where we ended last night, right here at 44.75, excuse me. We're right at a transition point or a zero. And when we see that, it's very, very common on zero DTE days to end up where you do have this flip. We don't see it clearly until the following morning to the OCC updates, but obviously the dealers do, and they landed squarely right at a very, very neutral point in their overall gamma exposure. When we take a look at the overall, what we call Expiration Profile, this tells us the amount of gamma above and below the current spot price that's expiring as a function of expiry dates, as you can see here on the x-axis. And this picture has changed dramatically from where we were earlier in the week. We're basically balanced, and that is indicative of not having a lot of pressure to the upside or to the downside. So we want to be very aware of that. There's not a lot of impetus to push us one way or the other. When we take a look at the overall SPX here, circle 1 shows us that we are in a net negative gamma condition. Circle 2 shows us that it's very negative, but it's less negative than what it was several days ago. It was about 250,000 a couple days ago, and so we are digging out of the hole, and circle 2 shows us that. Circle 3 shows us that we do have a tremendous amount of calls sitting up here at 4,700. So that is an upside target that we need to be aware of. Circle 4 is showing us down the downside. We have a dominant level at 4,400. Area of liquidity could be support until it is not, but just be aware the magnitude of that is very, very significant, even from where we are right here. 4,500 is interesting. We've dropped from 4,700 to 4,500 in the short-term gamma exposure. So 4,500 becomes the new bogey. And I think is important for us, because if we can push north of 4,500, we're going to encounter those JPM hedges at 45.10, and then the copycats up here at 45.20. We want to be aware of that. If we push north of 45.20, you can see there's actually a lot of positive gamma, and we'll change the regime over to a positive gamma environment, which is good. That will decrease volatility and potentially set the stage for pushing north. We're just going to have to watch and see what happens. That's it. So everyone, thank you very much for your attention this morning. If you have any questions or comments, feel free to reach out to us at GammaEdge.us. That'll take you to a sign-up page if you're not a member, which will take you to our Discord, 14-day free trial. All tools turned on. You get to kick the tires, meet the team there, and it's a pretty dynamic environment. You can also follow us, of course, and I ask that you do, on Twitter at GammaEdges with an S. Please like this tweet, and hope to see you in the Discord. Thanks, everyone.